Folks, in this video, we're going to talk about the possibility of a stock market crash in 2023 or 2024. We're also going to talk about the top stocks that I like to the short side. Now, before we get to the stocks that I like, I think it's incumbent upon me to talk about why I believe there could be a stock market crash in 2023 or 2024. And all you need to do is take a look at this chart here. This is the chart of BlackRock. A bit about BlackRock assets under management for 2023, $9 trillion, making it one of the largest banks in the world, a very powerful institution. Now, while the S&P 500 is up on the year 15.5%, BlackRock is down 2%. Now, the question is, why? This is a headline from December of 2022. Blackstone's $69 billion REIT curbs redemptions in blow to property empire. So that they are blocking redemptions out of one of their popular REITs. Why? Because commercial real estate is in a bear market. Commercial real estate prices for 2022 and into 2023 are negative. They're declining because occupancy rates are through the roof in every single major city in the United States. And BlackRock is not alone in holding the paper on these mortgages. This is a chart of the S&P Regional Bank ETF. These are the banks with the most exposure to commercial real estate, and we are talking trillions in mortgages that could go bad. And tonight on Sunday Night Futures Live, I'm going to be talking about how this real estate REIT announced on Friday, July the 7th, 2023, that they were going to likely return 19 properties, mostly hotels and commercial real estate, office buildings, to their lenders. Now, who carries this paper? Who has the risk of having keys handed to them rather than having loans repaid? BlackRock, and to a greater extent, the regional banks here in the United States. And just for perspective, while BlackRock is down only 2% on the year, the regional bank ETF is down 28.14% on the year, which is a clear indication that there's something very, very wrong in the banking sector. Now, what was the proximate driver of the crisis in the regional banks? Well, look no further than the Federal Reserve keeping money cheap for over a decade, and then increasing interest rates at the most rapid pace in history. Add to that, you had overpaid, well-dressed, slick-back hair banksters that were unable to manage their risk, resulting in a massive correction in the regional banks, which began in earnest back in March. The Federal Reserve provided a lending facility to carry these banks overnight. One might think that that lending facility is no longer being used. All is right with the world. Nothing to worry about here. That's not true. The fact of the matter is that lending facility is being used at the most aggressive pace since it was introduced. Now, do the risks to the economy, are they reflected in the equity markets? No, but I predict that they're about to. And you could argue that on Friday, July the 7th of this year, the stock market got a wake-up call. Because why? There is over a 90% probability that the Federal Reserve, after pausing in June, is going to continue raising rates again in July. So the proximate cause of as to why the regional banks are in big, big trouble, which is the Federal Reserve driving up interest rates at a very aggressive pace, it's not going away. And on Friday, the equity markets closed firmly above a 4% handle on the 10-year Treasury. And as yields continue up higher, and you have zombie corporations that need to refinance debt that they borrowed at near 0%, now they're going to have to pay higher interest rates on rolling over that debt, and that is going to hurt their earnings per share. And many of these companies do not have an earnings per share. Now, some of the names I like will begin with Amazon. Now, the reason why we like Amazon, and all these names, we'll just cut to the chase: Amazon, Chipotle, Mexican Grill, Nvidia, Tesla, Facebook, Meta, I should say. The reason why we like these names to the short side, besides the fact that they are very, very well run companies, we like them because of their optionality, meaning we could buy and sell options. We could structure a very risk-reward friendly way to short these names. The shares and the options are very, very liquid. And what I like the most is that these names have run very, very far, very, very fast, and some of them are at or nearing historical resistance. And we'll talk about what historical resistance means on these names in a moment, in particular, Amazon. So looking at Amazon, Amazon's had a strong year thus far. It has broken back above critical support. But when I overlay on this monthly chart, quarterly resistance, you could see that the algorithm is picking up resistance above right at around 137 per share. To me, that is an excellent risk-reward entry at which to get short. And what if we're wrong? What if the shares break out and close above 137 per share? Well, you stop out with a very small loss. That's the value of knowing exactly where your historical resistance is, as well as your historical support when you're looking to buy a stock on whatever charting software that you're using. We're using TrendSpider. Link below for 35% discount code. Now, on a fundamental basis, Amazon is sporting a 309 price to earnings multiple, making it ridiculously expensive. Add to that, the consumer is dead. One of the most popular search terms on Google right now is pawn shops near me, indicating that the consumer is struggling and that at some point in time, it is going to have an impact on discretionary sales. And that will have a very, very dire impact on Amazon stock. Now, taking a look at our other candidate, Chipotle Mexican Grill. Chipotle Mexican Grill had an outstanding earnings report last quarter. And you can see that this congestion area here, right at around 1740 to 1750, was for about a year a resistance level at which we broke out. And we have run up 49.73% on the year. Now, when it comes down to the algorithm and picking up support and resistance levels, I can overlay, as I did with Amazon, a quarterly overlay. And you can see that the only one of relevance that pops up is down here in dashed line, and that's going to act as support. So price target number one to the downside is going to be 1740 to 1750 per share. If that fails, we're looking at a price target of 1570 on Chipotle Mexican Grill. Now, what's the trigger here? Do we go short in Chipotle Mexican Grill in the next business day? No, of course not. Unless, of course, it breaks support. What might that look like? We'll stick with the monthly chart for a moment. Let's take a look at a weekly chart. Now, on a weekly chart, you could see that we were in a very strong bull run. We had a massive parabolic blow off top. We have since been consolidating. They tried to goose it up higher the week of June the 26th, only to get a reversal bar, and we are currently trading at a support level. So we wouldn't dream of shorting it right here, right now, because where it's at is at support. You don't go shorting into a support level. Where we would entertain shorting Chipotle Mexican Grill is a break below $20.20 per share, which would bring you down below this volume shelf weekly chart of CMG. And as with all of these stocks, the reason why we like them to the short side is not only the fact that they are A, nearing resistance levels, or B, have already shown some topping action. All of them are very expensive. And in the case of Chipotle Mexican Grill, it's sporting a PE ratio of 55, which is about 10 points higher than its historical average. So we do see further downside here for Chipotle Mexican Grill as the consumer begins to scale back on purchases. Now, the next stock is probably going to raise hackles. It's not actually, the next two stocks are going to raise hackles on many. Leave a comment below if you disagree with me or agree with me. The next stock, Nvidia. As with all the other names, we're going with a monthly view first because we want to take a look at the higher level view, the 100,000 foot view of the battlefield. If you're looking to short a stock simply based upon a daily chart and you're looking to carry that short overnight, you're going to have your face ripped off. You need to understand where that stock has been, where it is on a historical basis, so that way you are using your intelligence and data to drive your decision making of as to when you want to short a stock. Now, Nvidia on the year is up 191% on the year. Great stock. I'm not taking anything away from it. I've owned it. I've been short of it. We've made money on it a bunch of times. And at least once on the short side, we've had to admit our fault and move to the sidelines and live to play another day. Now, looking at this chart of Nvidia, you could see that we have, by and large, a parabolic blow off top. Does that mean that we have put in ultimate all-time highs? No, of course not. Using the fractal trend lines on TrendSpider, you could see that in the past we've hit this upper band of resistance. Usually that is a reaction to an extreme move, and that reaction obviously is to the downside because the stock has come too far too fast. Now, at current on the month of July, it's still early on here. A lot can happen. We can move higher. We can move lower. We could do nothing. Trade sideways. This is a doji star formation, sign of indecision. I have a 5-part video tutorial below, top 5 favorite candlestick patterns. If you want to learn more about my favorite candlestick patterns, one of them is the doji star formation, which this one is. And that video tutorial is free. Again, link below. So while we're watching the video, we're not ready yet to get short of the name. Let's go to the weekly chart. And you can see by the price action here, there's a lot of indecision. You had a bearish reversal bar on June the 19th. They tried to take it down the week of June the 26th, yet they rallied it off the lows last week. A tug of war between bulls and bears. So how does this get resolved? We have a rule. And that rule is whatever the primary trend is, the probabilities favor the trend. And in this case here, obviously we are in a bullish trend, so odds favor bulls. Now, when would we look to short Nvidia? Let's draw some lines. Here is your lower band of support, and here is your upper band of resistance. Now, should we break out and above this upper band of resistance? Well, then back to monthly chart. In all probability, we're moving up to this upper fractal trend line, which marks the upper trading range historically for Nvidia. Back to the weekly chart. Now, should we fail to hold this lower band of support, in fact, I'm going to create an alert here. Should we see a break below, say 410 per share, bringing us down below the lower band of support, well, then we would look to get short of Nvidia. And the opposite is true. Should we see a breakout above this upper band of resistance, we look to buy Nvidia shares. The caveat being is that when you take a look at the stochastics, which are a momentum indicator for the shares of Nvidia, they are extremely extended and they have not revisited an oversold level on a weekly time frame since October of 2022. Now, the next name that we like to the short side is Tesla. And again, I fully expect to raise the hackles on the back of some traders out there, and that's fine. Leave a comment below if you agree or disagree with me on these observations. But Tesla shares are up nearly 123% on the year. That in and of itself means nothing. It just implies that it's come a very, very long way in a very short period of time, and a correction is not out of the realm of possibility. Now, my argument for Tesla shares breaking down is a bit more technical. I could argue, yes, that they have a PE multiple of 71, which versus the S&P 500, which is priced at a 31 multiple, which is also very expensive on a historical basis. That's not primarily why I like the shares of Tesla to the short side. In fact, at current, we do have a short position on Tesla for full disclosure. The reason why I like the shares of Tesla to the short side is, on a monthly time frame anyway, that we are in an area, a range, where there is a tremendous amount of what I like to call overhead supply, meaning buyers from back here in 2021 when the shares topped out. They're just looking to get their money back now. They're looking to get made whole. So as the shares of Tesla turn from red on their P&Ls to green, they're clicking the sell button. Now, on a daily time frame, there are a couple of technical issues that I have with Tesla, and that technical issues are bearish in nature. First off, you could overlay the automated trend lines, and the AI is picking up the fact that we have a lot, as I mentioned earlier, a lot of resistance immediately above, as represented in red and in green. Initial price target for Tesla shares to the short side, 262.23, to this lower band of support at current 258, 259 per share. Now, the correction in Tesla has already begun, because what we did on July the 6th is that we broke down below the rising uptrend channel. On the 7th, they tried to reverse the shares, attempting to move them up higher, only to see sellers above, bearish key reversal. The only reason why I did not go adding more to our short position on Tesla is because there's simply no volume. Volume is very, very light. This is not an indication of institutional distribution. Now, should we get a break of Tesla shares down below this lower band of support and we see volume pick up, then I would be looking to add to our short position. Not until then. What I also want to point out is that momentum is beginning to wane. Note the lower highs on the slow stochastic. Also note that RSI most recently hit a high of nearly 90. So I would argue that the blow off top on Tesla shares has already occurred, and what you're seeing at current is retail money chasing Tesla stock up higher. They do have earnings coming up very, very soon. They could be trying to front run earnings, which is a very, very dangerous game. And for transparency's sake, I will either be neutral on Tesla shares going into earnings, or I will exit the trade in advance of earnings. I will not be short or long of Tesla into earnings. Way too much risk, not enough reward. Now, moving on to our last name, Meta, which is up 141.42% on the year. It has not had a negative month since October of 2022, but there's a problem. And that problem is, as mentioned earlier, technical in nature. You have a lot of overhead supply, meaning buyers from back here who are now beginning to see their losses turn from a loss to break even on their P&L, and they want out, especially when you have a stock that's sporting a multiple of 36, which with earnings growth last quarter of only 3%. So where is that overhead supply? Where does it begin? Right here, right at around 296 per share. What was the high of the month so far? 298.12. Where did we close? 290.53, right down below that support level. So you can already see beginning that you have motivated sellers that have been sitting with the shares of Meta in their portfolio for more than 2 years. They're starting to get made whole again. So we like the fact that Meta is nearing resistance. And what I liken resistance and support to is this, is if you're disciplined enough to wait for a stock to hit resistance before you short it, well, then you're going to have sellers of like mind looking to either A, sell the shares to go to cash, or B, shorts that understand that there are sellers above. They're going to wait for resistance just like you and me, and they'll short with the crowd. Now, where do I think the shares of Meta are going? Right down here. I think 245, 246 per share would be a great, great price target. And we could trade. Again, the reason why we like these names, we can trade options on them, or if we want to short the common stock, they're all very, very liquid. Unlike other names that are very, very speculative, thinly traded, hard to get good executions on options in particular, and God forbid you use a market order when you short or purchase the common stock. So of all these names, I think that Tesla and Meta face the most near-term prospects of seeing a sell-off. Now, we do have earnings coming up very, very soon, and I will reiterate, I would not be short of these names going into earnings. That is a very, very speculative way of trying to profit to the short side. If you wait for earnings to go into the rearview mirror, your risk versus reward increases dramatically. Folks, if you agree or disagree with me, leave a comment below, like, subscribe to the channel. Don't forget, we go live on Thursday nights and on Sunday nights, 6 p.m. Eastern Standard Time. Hit that notification bell. Don't forget our 5-part video tutorial on our top 5 favorite candlestick patterns, link below. Also, our sponsor, which is TrendSpider, 35% discount code below. I use it all the time. Talk to you soon. Be well.